In this video, let's talk about how to calculate the intrinsic value of a company. The company we're going to use is Bubs Australia. So this is going to be part 2 of my Bubs Australia coverage. And if you haven't seen part 1, I'll leave a link in the description box below. What is up everyone, it's David here. I have to admit, I am really rusty in calculating the intrinsic value of a company because I haven't had to do one for a very long time. But do you know what I'm not rusty in?
Asking you to gently smash that like button right there.
I did this in the beginning of every video so that if you want to support me, all you really have to do is that like button right there. That's it. Now without further ado, let's go. Now this video is going to be broken into 3 parts. The first part is a quick overview of Bubs Australia so that we are all on the same page. The second part is a step-by-step guide on how to calculate the intrinsic value of a company, and we're going to use Bubs Australia as an example. Third part is taking the intrinsic value for Bubs Australia. I'm going to tell you whether I am buying the stock. And then we'll wrap up the entire video with what I think I can do better next time. If you have any feedback when it comes to my process of calculating the intrinsic value, make sure you let me know in the comment section below because that'll be super helpful. For those of you who are not familiar with Bubs Australia, they produce and sell infant nutrition products to Australia, China, and internationally. So think of goat milk infant formulas. So as of recording this video, Bubs Australia is trading at 98 cents and their market cap is approximately $551 million. So in part 1, we established that Bubs vertical integration, meaning they control every single part of the supply chain, along with their deeply influential backers in China, makes them a very formidable foe against Bellamy's and also A2 in the future. However, they are still a long way away to go head to head with A2, especially if they don't have the rights to distribute their products in retail outlets in China. And that's essentially it for the overview on Bubs Australia. Let's move on to how we calculate the intrinsic value of a company. To calculate the intrinsic value of a company, there's really 3 main steps. First, you need to understand the underlying business, especially how it makes money and what are some of the key risks inside that business. The second step, we leverage what we know about the business to make reasonable assumptions about the future growth rates and also the operating margins moving forward. And the third step, we take the assumptions that we made in step 2 and apply it to a discounted cash flow model to estimate the fair price of that company today. Now what you see on the screen is basically how a discounted cash flow model works. All we're trying to do is estimate how much is all of the future cash flows worth today. Let me explain. So when you invest with your hard-earned dollars in a company, you're essentially expecting the company to pay you back your money plus some more. Otherwise, why invest in the first place? With some companies, you just have no idea whether you're gonna get your money back plus some more. And because of that uncertainty, you need to be rewarded for taking that risk upfront. That means unless the company can produce that kind of return for you, they won't have access to capital to grow the company in the future. That minimum return to access the capital you have is also known as cost of capital. So to estimate how much those future cash flows are worth today, we just want to discount them by the cost of capital. Now what you see on the screen really is the math behind it. R is the cost of capital and N is the number of years that you want to discount back by. So let's jump into my computer so that I can show you how I calculated the fair price for Bubs Australia. And of course, this video is not intended as financial advice. It's purely as entertainment purposes only, and make sure you always do your own research. So what you see in front of you is a valuation template that I built specifically for growth companies. All of the gray boxes you can change, and revenue, EBIT, net operating losses. These are very accessible numbers on Yahoo Finance. So the one thing I will note is that for net operating losses, just make sure you don't put any negative signs inside, just put in whatever the number is. When it comes to value drivers, think of these as levers that you can pull to change the outcome of the valuation for the company. Compounded annual growth rate is pretty self-explanatory. How much you think the company's revenue will grow by year on year. Target pre-tax operating margin. This is more when a company becomes more mature, it'll just move towards an industry average when it comes to their operating margins. And years of convergence really just means how long you think it'll take for the company to move towards its target operating margins. If it's 3 years, then it means that it'll take the company up to 3 years to move to a 25% operating margin. Other inputs and sales to capital ratio is really to calculate the reinvestment. Now, for a growth company to grow, you need to reinvest. and how much you can reinvest is dependent on how efficiently you can invest your capital. So I'll show you how I got that number in just a second, just bear with me. Now, when it comes to cost of capital, the way to think about this is that in the first 5 years of a young company, no one knows whether they can make money at all. And there's a lot of uncertainty. So you need to be rewarded extra during this time to make up for the risk you're taking on. Now, later on in year 5 to 10, as the company becomes more mature, they should have a stronger competitive advantage, and even better, they should be profitable at that point. So the uncertainty becomes less and less, so it becomes easier to access more equity capital, not to mention at that point, if you're profitable, the banks are probably willing to lend you money and therefore lowering the cost of capital. So first 5 years, higher discount rate, and then the next 5 years, lower discount rates. Tax rate, that's just our corporate tax rate in Australia, and that's 30%. Risk-free rate, that's our 10-year Australian government bond yields. You can change this as this change, but as of recording the video, it was 0.87%, which is really low. Now, probability of failure is exactly as it sounds. What are the chances that you think the company will fail sometime in the future? And if they were to fail, how much can you get back by selling off all of the assets? So this is the distress proceeds. Now, this number can be 0 if you want to. So if the company has no tangible assets and everything becomes 0, then you can put 0. Okay, so let me explain how I turned a lot of my assumptions into numbers. So there's a tab called Stories to Numbers. So if you go to that tab, it basically has some of my key assumptions and how I've translated into numbers. Now, when it comes to revenue, I want to quickly jump to tab number 2. You can see here that I have some historical revenue numbers for both Bellamy's and A2. I personally think that those two are probably the closest to Bubs Australia. As you can see, over the years, Bellamy's have grew by 40% year on year, and A2 have grown by 60% year on year. Now, the important note here is that A2 got their approval to sell in retail outlets in China in 2017. And a year later, they almost doubled their revenue because of that. At the same time for Bellamy's, only until the end of 2019, that's when they got their approval to sell in retail outlets in China. So personally, looking from Bob's perspective, I think that they can grow faster than Bellamy's because of their backing in China. But I just don't think they can grow faster than A2 without the approval to sell in retail outlets. So to be conservative, I gave them a 45% growth rate. Now, as the company matures, it's not likely that they can keep growing at 45% for the rest of their lives. It's more than likely that their growth rate will start declining to a more reasonable number. Now, the most reasonable number that you can put here is the 10-year Australian government bond yield. Because if they can't even grow faster than a 10-year Australian government bond rate, then you might as well put your money in government bonds. So to be conservative, for the first 5 years, they'll grow at 45%, and then for the next 5 years, they're going to move towards a 10-year Australian government bond yield. Now, to determine the target operating margins, we need to go back to tab 2 again. Bellamy's margins is approximately 17%, and for A2, it's approximately 30%, which is incredible, by the way. Personally, I think that Bubs Australia's vertical integration will give them a lot of efficiency in their processes, but I just don't think their margins can be better than A2 at the moment because they own that supply chain infrastructure. A2 doesn't have that kind of ownership when it comes to their supply chain. And because of that, I think that A2's operating model is less capital intensive compared to Bubs Australia. So their margins will be slightly lower than A2. So to be conservative, I gave them a 25% target operating margins. When it comes to reinvestment, one of the key assumptions we have to make is the sales to capital ratio for the first 5 years and then the next 5 years. So in order to calculate that, we have to go back to tab number 2. Now the formula for sales to capital ratio, I've actually already built it in the spreadsheet here, is you want to take the revenue of that year divided by debt plus equity for that company minus all the cash. So as you can see, for every dollar of capital that A2 has back in 2016, they turned it into almost $6 worth of revenue. Plus, it's also normal that as the company grows bigger and bigger, it just won't be as efficient when it comes to turning their capital into revenue. If A2 has a 4 when it comes to sales to capital ratio, Bubs is not at a point like A2 yet. They don't have the brand, they don't have the approval in China to sell in retail outlets yet. So to be conservative, I gave them a sales to capital ratio of 3.5 in the first 5 years and move towards a 3. Now, when it comes to cost of capital, the way I like to think about this is that the first 5 years, you have to reward investors for taking a chance on you because they really have no idea whether you're going to survive or even make money at all over the long term. And as you become more mature, as you find consistent ways to generate revenue and grow your revenue streams, your ability to access capital becomes cheaper. Maybe at that point you're profitable and the banks are willing to lend you money and you no longer have to rely on equity capital raising. So it's a reasonable assumption to start with a higher discount rate, say 10%, and move towards a more industry average like 8.5%. Now that we have all of the assumptions, we're ready to calculate the intrinsic value for Bubs Australia. So as long as you put in all of the inputs necessary in this input sheet here, all we have to do next is just to go to the output. This looks super scary, but if you're not really interested in the math or mechanics behind it, you can ignore this. What you're most interested in is probably right here. Now remember, discounted cash flows is just an estimation of how much all of the future cash flows are worth today. Granted, we've done all of the hard yards, we're taking away the debt plus the cash. The value of the equity within Bubs Australia is worth approximately $704 million. And if there is 563 million shares outstanding, then I estimate the value per share being $1.25. It's currently trading at 94 cents, which means that there's still a lot of upsides to be realized. Then the next logical question is, am I buying? So the answer to that question is no, I won't be investing in Bubs at the moment. Ultimately, I am a dividend growth investor. And because Bubs don't pay a dividend, it's actually outside of my strategy to put money in that company. So if I were to deploy capital to invest in Bubs, I will reconsider after they get approved to sell in retail outlets in China. Because at that point, I feel a little bit more confident about their competitive advantage, especially selling in China, given how hard it is to get that approval to sell in China. So let's wrap up this video with some couple important points. I think the valuation that I did can be completely wrong because I told my story. Now, depending on how you want to tell Bubs' story, your valuation could be completely different. And I will encourage you to play with the spreadsheet to change how you want to tell the story. When it comes to how I can do a better job next time, I actually took a couple shortcuts to not price the employee options as well as operating leases. So if I took into account both of those, the valuation could be a little bit lower. And I just want to apologize that this video is probably on a technical side, and if you found that to be super confusing, let me know in the comment section below and I'll take my time to answer a lot of the questions that you have. I definitely went down a rabbit hole for this part of the video because I really do miss valuing companies, but it took a long time to make. So if you want to support me, just make sure you gently smash that like button right there, and that will mean the world to me. And in my next video, I'll finally talk about what I think of Zip and Afterpay and all of the other buy now pay later type companies. So make sure you subscribe to my channel, click onto the bell so that when that video is ready, I can let you know. Until next time, my name is David. Otto will always do the honors and see you very, very soon.